It's finally happening on an ugly day where the Dow lost 71 points, the S&P plunged 0.53%, and the Nasdaq plummeted 1.13%. Wowza! They jeweled that Nasdaq. The market's finally reacting to the glut of new IPOs that are weighing on the averages like a steamer trunk on the investment public's back. I take no joy in this, but I told you so. All year I've been predicting that the IPO cycle would end with a whimper, and now it's here. Busted deals like Peloton on the heels of Smile Direct and Lyft and Uber. They're booing, are becoming the norm. I think there's a big reason why this market keeps getting hammered, especially the turbocharged growth stocks. Oh, boy, you see them today? It's gotten to the point where I hope the president actually follows through with the threat to block more Chinese IPOs, if only because so many of them have been unmitigated disasters for their investors. I know chatter about some limitations on Chinese investments by the president caused the market to get hit today because anything that's not flat out suggesting compromise indicates that we're much further away from a trade deal than the bulls had hoped. As someone who wants the Chinese to play fair, I think a ban on Chinese IPOs would be a blessing. But after sniffing around, that's not what's in the card from what I can tell. It turns out the talk is really about limiting American investment in Chinese companies. And it's not as sweeping or as negative as the market seems to believe. Look, the White House isn't happy with American pension plans, especially federal pension plans, having to add lots more Chinese exposure, which is what's recommended right now by an outfit called MSCI, which is the keeper of the international index weightings. That's what all the big funds follow. The administration doesn't want Chinese listings that lack the same kind of transparency as American companies, and it would prefer our investors not to buy the shares of companies with opaque financials that Mao would no doubt like. You know, to me, I think it would be simpler to ban new Chinese IPOs here altogether. But that's not in the cards right now. That's not in the cards, despite the fact that you may have heard that this afternoon. It's just not true. So, candidly, if you sold stocks on those rumors, in retrospect, it was ill-advised. I only took about 4 hours working on that one today. Unfortunately, we won't be catching a break from something else, though. A continued deluge of new American-style deals next week. When I look at the IPO calendar ahead of us, you know what? It makes me sick. I mean, we've got 5 money-losing biotechs on deck now to complement all the other money-losing merchandise that's been pumped out of us lately. Don't you feel like that when you're in this IPO moment, what you really are, you're like Danny Dufresne going through that pipe, right? I mean, wow. You know exactly what I'm talking about. I'm talking about Shawshank. Yeah, these deals are designed to rip the money from your portfolio. You know what? No, I have a better movie imagery. What this is like is Indiana Jones and the Temple of Doom when they reach in and pull your heart out. Kind of. All right, the closed rack that is Peloton was the straw that broke the IPO camel's back this week. We all knew the chute had effectively been closed for money-losing companies, but their underwriters didn't seem to mind. Although that may be changing. The only encouraging sign of this hideous moment was when an outfit called Endeavor, where my agent works, pulled its IPO. They got horse sense. How and why did they do that? Simple. Because unlike most of the junk that is being pumped out now, Endeavor actually makes a lot of money, so they didn't need any of this stuff. They were hoping to use their stock as currency to buy other companies. But when they saw the state of the IPO market, they said, hey, to hell with it. Endeavor didn't want to be lumped in with the Pelotons of the world. The company brought in $500 million of earnings before interest, taxes, depreciation, and amortization last year. So they have no urgent need to raise capital despite of what you may have read or whatever. I mean, I'm glad they chose not to swim in the IPO Gowanus Canal, which, for the record, was a very odd blue color the other day. Interesting. Blue. But, you know, kind of blue like, I don't like a crayon, like cerulean. Now, from this point on, you can't afford to own any of the newly minted money-losing IPOs because what you'll do is you'll lose money. You'll be living here.
A house of pain.
And I know they may have some potential for incredible growth, but the market doesn't want that anymore. You see what it did to all the high-growth stocks today? See, we're in the wrong stage for the business cycle. In fact, the only deals I want now are deals where raising money is a secondary concern. In most cases, these companies are desperate to do some fundraising. I want you to stay away from them.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.